Hey folks, this is your weekly, most comprehensive look at the world of business, finance and economics. Welcome to another conversation on Business Redefined. We want to talk about matters corporate banking now. 2024 has been a very challenging year for the banking sector from an asset quality standpoint. John Okulo is the man who heads corporate banking at KCB Group, and that is the largest by asset base in this market. Glad to have you on set.
Thank you, Julian. Pleasure to be here.
John, how has it been for you when we look at the numbers coming in from the banking sector? Of course, the P&L looks very fantastic, but if you look at the asset quality side, there are many questions. From a corporate banking perspective, how has it been?
Yeah, I'd say, Julian, it's a journey. Business, financing businesses, you've got to think long term. You've got to appreciate that businesses will have challenges. There'll be ups when the economy is looking good, and there'll be periods when there are difficulties, like we had last year. A key thing is to have a medium to long-term view and to work with your customers on solutioning, and also to learn from past mistakes.
Yeah.
That either a financier or a customer has found themselves in. And I always say it's important. Hindsight is 20/20. So it's very important to be able to assess what went wrong, how you can resolve the problem, and how you can grow to be better.
Yeah. John, we have just dived right straight into it, but let's walk back. There are many Kenyans who might not know what exactly is corporate banking.
Yes.
Just give us a one-on-one.
Okay, so corporate banking is part of a commercial bank that looks after businesses, typically larger businesses. They could be family owned, they could be corporations that are all owned through institutions. They could be for profit type of businesses. They could be not for profit, such as the PBOs that we're meeting today. It also involves engaging with government institutions, government agencies, parastatals. It's part of the financial sector that looks at the total financial requirements of a business.
Okay.
So you start from the basics. You've got a current account. What does a business require? It needs to be able to collect its receivables. So you have to have the technology that supports the collections. We've moved from collecting largely cash at branches to electronic forms of collections. The businesses also have to make payments, so you build solutions around those payments. Between paying creditors, collecting from debtors, stocking up, you need working capital. So we provide financing for that. The financing would come in the form of overdraft facilities, it would come in the form of short-term loans, it would come in the form of import loans, it would come from letters of credits, guarantees to creditors. And then on the debtor side, you've got the needs to speed up collections, but at the same time allow a business to provide credit terms to its customers. So you provide receivables financing structures. Once you've looked after the working capital cycle, then businesses need to expand. So you need to be able to give them loans for capital expenditure. Businesses need to upgrade their equipment. They need to ensure that they operate efficiency. So you provide medium to long-term loans depending on the type of equipment and the business's ability to sustain repayments for that equipment. You could provide it in local currency, in Kenyan shillings, you could provide it in foreign currency. When you do that, then there are different risks.
Of course.
Yes. If you're financing a business using foreign currency, say US dollars, you have to ensure that they have inflows in US dollars, so that they don't get caught up
mismatch.
Fluctuating exchange rates. If you're financing in local currency, then of course there's more volatility in the interest rates for local currency versus US dollars. So you need to be able to come up with hedging solutions. At times it could be a mix. You also have to keep abreast of the business's aspirations, and that's where the relationship management comes in. So you've got businesses. I started corporate banking in 1995, so many years. a business that was a MSME in 1995 could be a very large conglomerate in 2024. So are you able to keep pace with that business? Are you able to work with the business owners to ensure that their aspirations for the next 5-10 years are met? If it's a family-owned business, you need to be able to discuss, to build a relationship to a level where you're discussing succession planning. Do they need, are they going to keep the business within the family, or would they want to incorporate it in a different form and list it or bring in strategic investors? We're in 7 countries in East Africa. Many of our businesses operate in all 7 countries in one form or another. They may have established a physical presence there and incorporated there, or they are working with distributors. How do we serve them? Using all the KCB Group subsidiaries and ensure that they're able to conduct their banking relationships through a central relationship. And it's not always central out of Kenya. It could be a Tanzania conglomerate, with its head office in Tanzania that's expanding into the other regions. So we have to think group, we have to think regional, as opposed to just Kenya-centric. But how do you give the business owners or the business leadership the comfort that you can serve them in all 7 countries seamlessly and provide them the value proposition that they expect from you as a group entity, but also at the country level, because the countries differ in business practices and expectations.
Let me just hold you there, John. There's something which you touched on which I don't want to lose sight of. You've spoken about addressing the working capital cycles of business. And this year in particular, many businesses we talk to, I'd mention majority being in the small and medium-sized category, have really struggled with this. How has it been for you as a bank, and what sort of intervention measures are you putting in place?
So from the starting point, we always believe that the business owners, the leadership in businesses understand their businesses much better than we do. We are bankers, we are financiers, so we can discuss the full spectrum of financial solutions. We can talk about, the need to take on insurance. If you have an event that impacts your revenue, then you take out, some insurance to cover you for that. But the fundamental notion is that the owners of the businesses, the business investors understand their business better than we do. We come in with advice. So we'll tell you that based on our analysis of your financials, of the industry in which you operate in, of the macroeconomy, we believe that your business can sustain this level of debt. Now, if you're the owner of the business, you may be happy or not happy. If you came to us seeking a certain amount and we are saying, but we believe your business can only sustain X minus 1, we'll be able to explain to you why we believe that, because you need to. I've always told business people there's a difference between ambition for growth and sustainability. And the best way to get to your ambition is to ensure that you have a financing partner that can speak candidly to you, about their view as an independent partner, on your sustainability. Now, working capital is not necessarily coming from overdrafts or bank debt. It could be coming to extended credit term agreements with your supplier. So instead of borrowing the money and incurring interest, we could issue guarantees to your suppliers, so you benefit from credit terms. It could be, as I mentioned, having a receivables financing structure so that you give your customers credit terms, but the bank discounts those receivables. Those are the type of discussions that we have. It's always important to ensure that one has a healthy level of owner's equity in a business and debt, so that in the event of unforeseeable events, the business doesn't struggle.
I see. Good point there. And another thing which you touched on, which was very important, was on the side of FX.
Yeah.
Because in 2024 in particular, we saw a huge shift. We had so much turbulence in 2023.
Yeah.
After refinancing the Eurobond, then we had relative stability, if I could call it, in this market. Just paint for us a picture in terms of how you have then postured yourself in terms of hard currency versus local currency in terms of lending.
Yeah. Okay. So the challenges with FX in I think latter end of 2022, 2023 was a culmination of various events, both global and local macro issues. And as KCB, we had a view. We understood the plan that the government had to stabilize the currency. Yeah. So we were confident that we'll get to an end where there'll be stability, but we knew that there'd be turbulence. I don't think that anybody knew exactly how turbulent it would be, or when the end result would come through. Thankfully, February, after the refinancing of the Eurobond, we entered into a period of a stable currency.
Yeah.
But I think that should not make us forget the lessons learned. Yeah. And the lessons that were learned for many businesses is you've got to ensure that you have your supply chain sorted out. You need to have a supply chain that can weather the storm. There were issues with shipping through the Mediterranean. There was the crisis in Ukraine. There was the after effects of COVID. So all that taught us a lesson that businesses need to be able to have a diversified supply chain. It also made financiers realize that, yes, you can lend in foreign currency if there are foreign currency inflows, but you've got to be very clear where those inflows are from. Yeah. If you're invoicing someone in Kenya in dollars, and there's a challenge with dollars in Kenya, whether your invoices are in dollars or not, you'll still feel the impact.
Yes.
Yeah, or if it's coming from the region. So you need to be very clear on the source of that inflow. But we are a country, and all the 7 countries in which we operate in, we've got, the local currency. There are some countries which are heavily
Dollarized.
Dollarized.
Correct.
But fundamentally, the right thing is to borrow in the currency of your receivables. Short-term working capital, import finance, 90, 180 days. You could take some dollar loans for that. But you have to ensure that your costing is right, so that you don't end up importing goods and the cost of your raw material ends up being higher than what you can sell at because of the exchange rate.
How do you harness the opportunity presented in the region, given the sort of footprint that you guys have?
Yeah, I think the most important thing for us is to basically your question is how do we leverage off
Correct.
our regional capabilities? Yeah. So of course there's the technology, the core banking systems, the service centers, which can be unified so that you provide a seamless and efficient solution. But you also have to break the borders, the mental borders that we have. That yes, we're in 7 countries. Yes, there are physical borders. There are differing regulations, but our customers are operating within these countries, and as far as they're concerned with their operations, there are no borders.
Yeah.
It's just different towns and cities. So we have organized ourselves, our relationship management team, to be able to handle groups that operate across the borders. We are able to leverage off the differing levels of capital within the banks, especially with KCB Bank Kenya having a large capital base to support some of the lending into those regional customers. But it all goes back to relationship management, understanding what your customer needs, and then solutioning. Using digital platforms, of course, is important because that gives you scale and reach.
Yeah.
But fundamental thing is, what is the customer looking for? Build the solution and deliver it.
Okay.
Yeah.
John, as you look into 2025, I mean, granted, none of us has a crystal ball, but what are some of the things which you expect will basically shape the broader banking sector and specifically corporate banking?
As you said, there's no crystal ball. Yeah. I think we're looking at a period of growth. Yeah. I think the regional economies has come through significant challenges, as I mentioned. Those FX, there was some supply chain issues. There was the increase in shipping and fertilizer and other commodities. The increase in costs globally. Yeah. But I think we are getting into a period of stability. Yeah. We do expect growth. We do expect that certainly the service sector will continue to be the key driver of a lot of our economies, and digitization will continue. Regional integration by businesses will continue, irrespective of what regulations there may be. I think there are changes going on globally, in the political environment in some of our key anchor countries, and we'll understand what that means for us. But Julian, it's a question of managing relationships. Just depending on which direction the tide is flowing.
Cost of funds. We had a very tight environment in 2024. Outlook 25.
We're grateful that at least in Kenya the cost of funds are coming down. It's coming down, and for shillings it's coming down, I think, much faster than many people would have predicted. That is good for business. We do need to see lending rates come down as fast as the T-bill rates are coming down, and I believe that if that happens, it'll be good for everyone. KCB, I must say that we did maintain our base lending rates as one of the lowest in the markets at 15.6%, and we did that deliberately because we felt that it was important to stand by our customers when they needed us. There was that 6 to 9 month period when interest rates were going up rapidly, and that was in line with the required monetary policy to deal with inflation and so forth, and stabilize the currency. So we were confident that if we could try and stick with our customers for as long as possible by maintaining reasonably stable rates, the tide will turn. We're happy to see that tide turning. We're happy to see the market generally coming down, and we hope that we're now going into a period where borrowing becomes more affordable, and so businesses can invest.
John, you mentioned the issue of the tide turning not once, and I'm just curious because one of the questions I get from Kenyans is when we look at the numbers, the interest rates, inflation, FX, it all looks like we have turned a corner, but our micro realities are very different as households, as businesses. Where do you think the disconnect is, John?
It's really important for all of us to empathize with what consumers and individuals in different sectors of our societies are going through. It just varies. If you're in a sector that's been struggling, it takes time for you to get out of it. If you're in an environment whereby your income has not gone up, but your tax bill has gone up, then it's going to take time for things to adjust. What we need to do is to be able to appreciate that a stable macroeconomic environment, a stable fiscal environment where the government is able to collect enough revenue to run public services and projects, and to develop infrastructure, is what allows for a stable microeconomic environment. So it's possible that the macroeconomy has stabilized much faster than the microeconomy in certain sectors. Yeah, and the hope is that as interest rates come down, then it becomes cheaper even for the individuals to borrow, which means that the burden that they've been carrying from servicing their mortgages and so forth reduces. Yeah, so I think we all need to work together to inject the fuel that this economy needs. Yeah, to put money into people's pockets.
All right. Finally, John, give us your parting shot as we wrap up this conversation. What are some of the things you think Kenyans should take out from your thoughts on the outlook?
Yeah. But I'd say to take out about KCB. Yeah, because I'll speak about KCB. We're passionate. You know our values, and we always say it's for people for better. And we truly believe that we stand for the improvement of people's lives through the provision of financial services. And so I'd like Kenyans to challenge us with providing financial solutions. Yeah, if you're a KCB customer and you feel that we're not up to scratch, yeah, or you feel that we need to change something or to provide you with a solution, challenge us. Yeah, we're accessible at all levels, whether it's at the branch or at the head office level. And the importance of having these, call them challenging discussions, is that it forces solutions. Yeah, so that would be my parting shot. Don't put yourself in a situation where you believe that the bank cannot assist you. Yeah, if you have a project in mind, approach the bank. Tell us what your project is. We'll tell you the requirements that we have for financing it. If you're not able to fulfill all the requirements, let's discuss the solution.
All right.
Yeah.
We've been having a conversation with John Okulo, Director of Corporate Banking at KCB, touching on a raft of issues in terms of the lending environment. We've discussed foreign exchange, we've discussed the macro policy space, and now we're looking forward into 2025 and to see how that environment plays out and ensure that we have affordable credit in this market. Keep it business defined for all the latest on this development. Stay tuned.